Let's start with the investment world. What makes a good investment?
I think this is something a lot of people get wrong. They think it's about growth often, okay, or something new. Neither of those things in themselves to us matter by themselves. The most important thing, and without which it's for the, let's say, the types of investing that we do, is high barriers to entry, the moats that Warren Buffett has talked about. Now, before we dig into that, can a distressed asset of a piece of real estate that's selling at half price because of a liquidation also be a good investment? Yes. So can there be a role for cheap average assets? Yep. Let's call them low quality assets, which are trading at big discounts to replacement cost. Yes, that's a type of investing that can work. Yep, that I've done in my time. Yep, cheap average businesses or cheap bad businesses. But I don't feel that I can have any confidence in that type of investing because the earnings power of those average businesses is unpredictable.
So what are good moats?
The most important answer is ones that are sustainable. Okay, a lot of people, and ideally you would have multiple moats, multiple pieces of defense.
And there are many. And just yes. Moats is basically something that means that the business is difficult to replace.
Yeah, difficult to compete with. Yes, yeah. And replace. Yeah. Two substitution risk and competition risk. Those long term become very difficult because. Why is this so important? Competition kills profits. Yeah. Yep, that's as simple as that. Substitution eliminates your business. So we look at there are many moats. One which most people don't look at, most investors don't really look at, actually, interestingly, is irreplaceable physical assets. Okay, we're in a world where people just look at earnings. They don't look at asset value or physical assets, and so we like quite a bit of infrastructure. Airports, for example, one of our investments, which has been the airport group in Spain, where the government privatized it. Yes, AENA, and you just they'll never build a second airport at Madrid or any other places. These are, natural monopolies, and so. But that also applies to toll roads and railroads and telecom towers. So there are many forms of infrastructure, transmission towers that are hard to compete with because they're natural monopolies where of course, some of these things can be overbuilt, like cable. So there's a form of infrastructure, but it's usually, and you have to look at the details of case by case, very unusual to try to, and usually you don't get the planning to build a second airport, so no economic case to it.
I mean, I can't remember how long they've struggled to get an extra runway at Heathrow.
Right, so planning, exactly, planning, and then roads, there's no economic case to build a second road, or you don't have the land. So for different, literally no. So infrastructure is physical assets is one. A second is IP, but intellectual property. That's right, and which is so advanced. Okay, that it's very difficult to replicate.
So what kind of intellectual property are you thinking?
One space we like is aircraft engines. And there it's a very complicated product because the materials complexity, the engines run at such high temperatures that metals melt. And so many different things have to come together. Yeah, thousands and thousands of complex parts. So that's a business where there are only 2 players in narrow body engines and 2 in wide body. And there have been no new entrants for more than 50 years. The last new entrant was GE. And so that tells you something. Yeah, it's a big industry, but it's so complex, very hard to enter. Another barrier to entry is installed base, okay, which applies to the aircraft engine business. Once those engines are there, they, for various reasons, you get the spare parts business on it. And another of our barriers to entry is scale, although that's not a guarantee of competitive moat. Network effects is another important barrier to entry. You can see this in assets like Visa, Meta, yeah, 2 examples of network effects, and brands are another barrier to entry. But I'm not saying every brand is powerful, but you think about a McDonald's, it has a value. There are some brands which are powerful and sustainable, but not all. And I'll mention one more moat, which is customer switching costs. Take mission critical software. Once it's installed, companies are very reluctant to mess with it and switch because of the complexity.
How important are recurring revenue streams for you when you look at businesses?
It is important, but the predictability of when they recur is not. Okay, let me give an example. So what's most important for us is something slightly different, which is essential product or service. We don't like things which are discretionary. Okay, so one space we've invested in for a long time is rating agencies. And here,
these are the people who basically give kind of character to different type of
they
bonds.
say, is it good or bad? Yeah. To people who invest in bonds, they say, is it investment grade, non-investment grade, give for research, and if you like, bless it. And there, you can actually defer. An issuer pays for the rating, but they don't have to refinance their bonds, which is a big part of it, in any given year. They can delay and defer, but eventually the debt has to be refinanced and rated. And so and so I think essential need is the bigger point. But usually our companies have recurring and predictable revenue streams of essential products. And so,
do they have to grow?
Depending on valuation, not necessarily, or that's not necessarily at a fast rate. Okay, and growth can come from 2 forms: volume and price. So you have to break it down. Now, why isn't growth as important as investors usually assume it to be? Because you can have profitless growth. The airline industry over 100 years has had a lot of growth. Airline travel has grown at 5% a year. Continues to grow consistently. But airlines as a business, cumulatively and collectively, have made almost minimal profits, despite growth, because of the very low barriers to entry. And so, I would say growth without barriers to entry is not a combination that you want.
Some of these businesses are quite capital intensive. Like, it's not cheap to build an airport.
Yeah.
Does that matter for you?
Well, you have to look at, like everything, into the detail. And some airports all airports have regulation on landing charges, but the non-landing charges are unregulated. The shops, the advertising, the VIP lounges, the parking, and the so-called dual till regulation. One till is regulated, one till is unregulated. and those are very low capital intensity. Yep, it's in effect. Yep, and high returns on capital. They grow because there's more and more demand for travel, and and again, capital intensity by itself, it's part of the equation, okay, but it's still and it tells you how valuable growth is, okay. But what trumps, if you don't mind that expression, what trumps the all of this?
It's still a valid expression. Don't
yes, what trumps all of this is the barriers to entry. Okay.
What about regulation? You've been big in things like Red Electrica.
I'll go into that, but I want to go back to the point about growth can come from two forms: price and volume.
Yeah.
Okay. And most companies don't have pricing power. They can only price, if they're lucky, at inflation. And that's why people don't focus on it. They don't even look at where growth comes from. They just assume it's volume plus inflation. But there is a special group of super companies that can price above inflation. And that's, as Buffett taught, the test of whether you have the moat. Okay? And this real pricing power above inflation can be very valuable. Because if you can price 1% above inflation and you have a 20% profit margin, your profits will grow 5% faster than revenue. And people don't go into it or analyze it because there's so few companies that have it. But this is something we have a lot of our investments have this.
Because incremental pricing is pretty much all profits.
That's right, and it's very potent if you have the lower your margin is. So this is why you asked about growth, and is it how important? If you ask about volume growth, but I have low volume growth, but I have a lot of pricing growth, that's actually more important because of the leveraged effect of there's no cost associated with it.
Regulation.
Yes.
You have been in a lot of regulated businesses.
Yes, that's right.
You mentioned airports, but you've been in Red Electrica, which is like an electricity transmission company. You have done quite a few of these things.
Yes, I have. And actually, it's a general risk because if you have barriers too low, competition or substitution eliminates your business and your investment. Barriers too high, regulators may come knocking on your door. Yep. Every case is different. Yep. And the ideal case is that there is competition, but weak competition and apparent competition. Okay, so...
Tell me, what is apparent competition?
Yeah, well, it's really weak competition and rational competition. Okay, so take some water examples. Pratt & Whitney competes with GE and Safran. It has a 25% share of new orders. It has a product, but it's not nearly as good. Yeah, it's got 35% of its engines grounded, multiple technical problems. It's lost a lot of trust, but it's there competing and for new engines. Yeah. But price isn't the most important thing in this industry. Reliability is. Yeah? And so as it struggles, it has to raise prices because it's got lots of difficulties. And sometimes where there is competition, that competition chooses not to compete, generally speaking, not a specific industry, decides to be rational. Yeah. And compete on non-price based approach. Okay, and then the detail matters. So you might have looked at Heathrow Airport and say, oh, that airport is fully regulated. Airports can't be good. But if you look into the detail of AENA, it's a different animal. It has a piece that's regulated and a much bigger piece, 70% of the value, maybe more, which is unregulated. Yep. And so maybe the unregulated business. The regulated business will give you a bond-like return, 7%, but the unregulated give you a much higher return. Do you see? So
another group of businesses you've been very big in has been the stock exchanges. Both Deutsche Börse, London Stock Exchange, and so on.
In the past, yes.
Yes. Why were they so good?
In the case of Deutsche Börse, starting with that, they had a derivative business called Eurex, which was a natural monopoly. It was a network effect. This was the barrier to entry. That liquidity of a marketplace for trading bond futures, European bond futures, the network effect of getting best prices in the most liquid market meant it became what is termed a winner-takes-all or natural monopoly.
Yeah.
And once you have that liquidity, very hard to move people away. Price, you can never compete on best price. And London Stock Exchange has that for LCH ClearNet business, a clearing business. And so where an exchange can, CME has it on US futures, establish this natural monopoly by being the first mover, okay, the winner takes all, then these exchanges can be very good. But of course, they've changed now. London Stock Exchanges in many different businesses sells data, and half their earnings are from data, and that's non-proprietary data, reselling non-proprietary data. So it has a vulnerability on that piece. They're no longer just what they used to be. And then there was a lot of growth without capital. Yep. As people came and traded more, as capital markets grew, you grew without capital, which was very valuable.
What are the type of companies you would never invest in? Type of industries?
Yeah, that's a good question. We have a long list of companies we don't invest in. We're very focused, and we call them the risky and bad industries. And I have invested in some of these in the past, but I've learned.
Sure.
Banks. Sorry for that as a bank.
No, we are not the bank. We are in the central bank.
Central bank.
Central bank is good.
Yes, central banking can be good. But we don't like banks. We don't like banks.
And why not? Why not? Why not?
They're low quality of earnings because they're very leveraged. And much more than people think.
Yep.
Because people look at equity to risk-weighted assets, but equity to total assets. Many banks have run it 100 times, and so, two, they're opaque.
You can't look into them.
You can't. Yeah, you can't. I remember pre-financial crisis, I had a look at Credit Suisse, and I sat down with the then CEO Brady Dugan and said, put his balance sheet in front of him from the annual accounts, and said, "You have a multi-trillion dollar balance sheet. Can we walk through the line items? Because I don't understand it." He said, "I don't either." And he was a very honest guy. I really liked him.
Very
was very honest. And
okay, so banks you don't do. What else do you do?
And the other reason for banks, this is very important, that sooner or later you may find someone without a lot of intelligence comes to run them, and then it can be toxic. Yeah, people going for growth. Anglo-Irish Bank, if you remember that one, Nikolai,
sure.
Yeah,
of course.
And they just can destroy the shareholders, by getting bonuses, Bear Stearns, and non-alignment of interests with leverage and opacity, and
so what are the other?
And it's a commodity. Others, many. The auto industry is obviously a commodity. Retail, insurance, the commodities, the commodity manufacturing, tobacco. The truth is, anything in most things in manufacturing. Okay.
So
most industries are bad industries.
Yeah. So Chris, it doesn't leave a big universe.
Correct. We say maybe there's 200 companies that we consider to be high quality and investable. I'll list you a couple more. traditional asset managers, bad businesses. Yeah, speaking as one. Fossil fuel utilities, bad businesses. Airlines, bad businesses. Wireless telecom, bad businesses. We think media is bad. Advertising agencies, it's a very long list. Why? Because it's competitive. And with existing players and new technologies. And the one important thing that I've learned in my time in investing is investors underestimate the forces of competition and disruption. Because they just look today. Maybe there's a new company which has a first mover advantage, but then competition comes in, substitution and
where does it leave the big US tech companies now?
Yeah, so there's a lot of power of incumbency.
Yep.
This is another important point. So let's take a company, Microsoft, okay, which we've invested in, and one of their barriers to entry is bundling, okay, or maybe because it creates a customer switching cost. What do I mean by this? So the Office franchise, which we're all familiar with, has many products in it. Your applications, word processing, Excel, your email, security, different things, and they sell it as a bundle. Yep, they don't disaggregate it. And when a new product or a potential competitor enters, they can add it to the bundle. So Zoom came out with video conferencing, and they could have potentially, added all the things Microsoft does to that. So Microsoft had to respond, and they launched Teams. And they were able to distribute it through the bundle, free to everybody. And even though Zoom, some people believe was a better product, or is a better product, Microsoft won that battle because they had the installed base, the incumbency, which we talked about, and high switching costs because once people are using their Office software, they don't want to switch. And so people started using Teams. Okay? Something given to you free. Why? Because it was good enough. Yeah? It didn't have to be the best if it's free. Yeah?
What about the other tech companies?
We have a position in Alphabet, and which is maybe our most risky investment, where they're clearly the company, and it's just one of our smallest investments as a result. It's and where we have some level of protection because there are businesses like YouTube and their cloud business, which represent half the market cap today, and their cash and other things. So it isn't all search, but search is critical. And so can they out-innovate competition? Yeah, there's a risk of search fragmenting, as competitors come in and try to, but it's a question mark. We don't think so. We think they have a lot of advantages of their data to offer higher quality search results, and but competition is increasing.
Talking of which, how do you think AI will change the investment landscape here?
It's going to increase disruption in ways we can't even predict. But there are things like call centers will all go bankrupt, and another segment is Indian outsourcing companies. Yep, who do coding and things like that. Demand for those services could collapse because AI can do coding, with half the people. Yeah. Yep. So there are, but AI will increase the productivity and lower the cost base of all companies, and so if you have a company with these barriers to entry, it's going to be worth more. I think for generally competitive businesses, if you don't lead, you could become uncompetitive and be disrupted. Yeah.
So now we have identified one of these companies. Let's say, I don't know, Aena or Rolls-Royce or Microsoft. How do you value these companies? What is your valuation tool?
We don't even look at that until we get comfortable that the barriers are so strong it will be around. Now,
okay,
that's
so
not,
now
yeah.
big
And
barriers,
then,
big
fine,
moats.
fine. So
we think it will be around.
Yeah, we think it'll be around.
We think there will
Then-
continue to be an airport in Madrid.
Right. We'll do reference checks on relevant people, okay? So, and see if we're missing something. So when we were looking at investing in aircraft engines, we spoke to the CEO of a former CEO of one of the competitive companies, and he confirmed our thesis and actually said the margins should be much, much higher. Okay, and over time they will go there. So that's one of the pieces of diligence. We will assess management, where I think it's important, but not critical if you have the right assets. Ideally through meeting them. Talk to competitors, get their view, and look at competitive companies, look at the track record of the company, and usually you don't understand everything, and usually the things you find out are bad things, and I think we'll discuss it with our team, and we want to hear competing views. Yeah, we have some members of our team who are just inherently bearish, and they're good for testing the bear case. We always want to hear how could technology disrupt, and or just what competition and.
Are you a bearish guy?
Not particularly. No, I've
What kind of valuation metrics do you look at? P's, cash flows? Do you do DCFs? Do you have like 50-page spreadsheets?
All of those,
right?
All of those, but not 50 pages. You know, that's but really, honestly, one of the things we learned is, there's a really important point, is that we can have an advantage through long-termism. Okay, which is the average stock is held by an institutional investor by under a year, or the stock market in the US.
How long do you hold it?
Our average holding period of our current portfolio is 8 years.
8 years.
Yeah, 8 years. I'm not saying that's the limit. It's just we've on average, some we've held for 13 years, some new investments like GE Aerospace 2 years, but the weighted average holding period is 8 years. Yep. So, but it could be 10, it could be 20.
Yeah, no. I love long term, right? But how do you install that type of thinking into your organization? I mean, you're straight out of business school. You're straight out of business school. You want to, hey, I mean, went to Harvard like you did or whatever. It's just like, hey, let's do some stuff. Come on, let's do some stuff.
Yeah.
And it's just like, hey, okay, let's buy something and hold it for 8 years. Right? You come home to your partner every day. It's just like they do nothing. They just sit there and own for 8 years.
Really, if you are in the private equity world, that's normal. Yep. A private equity fund would hold an investment for their 10-year life funds normally, or longer, 12 years, as you know. And so we it's an overused expression for some, or misused. We take a private equity approach, i.e., that we have to hold the company forever, because the stock market may be at very bad prices when you want to sell, if you need to sell, and so I really think you need to have that approach, and so the way we really like our long-term valuations, DCF, the most important things, and here's the thing.
DCF, you take the cash flow and you discount it back to today.
Yeah. But here's the thing: the longer you can look out, if you've got a great company, the more value there is. Take a company we own, Moody's. Moody's
A rating,
rating agency. So it's been around 100 years. What do you think the average? I can ask you a question, make it fun. What do you think the average revenue growth over that 100 years has been?
I'm going to look like a total fool, but
100 years is a long time.
7%.
10.
Wow.
Yeah, so it's a very unusual number over a very long time period. And so investors have always underestimated its value, including myself. Yeah. And I bought the stock during the financial crisis at 10 times earnings, and I even bought shares Warren Buffett was selling, and he reduced his stake from 25% to, I think he's got 15%, and Berkshire. And
Are you kind of secretly pleased having bought something cheap from Warren Buffett?
Yeah, but then I sold it. I doubled my money. I went from 10 times earnings to 20, and I sold it at $100. Bought it at 50, sold it at $100. I thought I was clever, but the earnings kept compounding.
So did you buy back?
I bought it back at $150, so now it's recently $500, now $400. So it's because actually the intrinsic value compounding matters more than the stock price. If you have a great company, it will grow intrinsic value.
Absolutely.
And the multiple, here's the thing about the multiples, they matter less than the growth when you look at it over a longer period. But most investors are unwilling or unable to invest on a long-term time horizon because either they don't know what they're doing, which interestingly goes back to what they think it's risky, which goes back to what Warren Buffett was when he was asked what the definition of risk was. You know what he said? Not knowing what you're doing.
So really good nugget here is that if you buy something which is really good, it doesn't quite matter what you pay for it because it will grow.
Secondary over a long, let's just say it like this, the multiple to a point, whether you buy it at, if it's growing, it's all maths. Yep, you've got to look at the growth rate, the terminal multiple, all the multiple things. But if it's increasing intrinsic value at a good rate, you will undervalue it if you look at it over a short horizon. Yep, I can be saying it like that. And if you're willing to hold it for a long term and extract that intrinsic value growth, it'll be worth more to you than other people.